Consolidated statement of financial position. Before we deal with the example, let's look at the little definition. Basic consolidation consists of two procedures: canceling out items which appear as an asset in one company and a liability in another, then adding together all the uncancelled assets and liabilities on line-by-line basis. Let's put aside those complicated book sentences and try to understand it in simple terms. Ahmed and Lala have been married for a long time. If we consider them separately, they each have their own stuff as assets, just like they have their own salaries and expenses. For example, both have cars, credit cards with outstanding balance, bank accounts, and little cash. Now, in addition to this, let's imagine that near the end of the month, Lala runs out of money and borrows $50 from her husband, with the condition that she will pay it back on salary payday. But everyone knows that such debt is never paid back. But anyway, let's continue with other example. Now, we know the stuff, values, and debts they have individually. But if we change our approach to the question, how can we find out that how much they owe and own together as a family? Naturally, by combining all assets and liabilities of the same type. Now we can say that the family has a car worth $34K, bank debt of $1,700, cash of $1,242, and money in bank of $1,120. If you notice, we cancelled borrowing wives from husband. Is this step correct? Yes, because it is an action, or how to say, transaction within the family, not a debt of the family to the outside. For this reason, it is not taken into account in the consolidation. As we said earlier, in the procedures, items that appear as asset in one and as liability in another are cancelled, such as the borrowing by Lala from her husband. All other items are collected line by line, since the exam questions are taken from the study book. Let's revisit these tough book sentences. What is consolidation? In general, consolidation means presenting the financial results, assets, and liabilities of a group of companies as a data of the single entity. But when does it happen? When do we consolidate? Answer is when one company controls another. Wait a minute. Control? What does it mean? Let's try to figure out. Let's imagine two restaurants open face to face on Bakuguba Highway. One of the restaurants is owned by Lala and another one by Ahmed. Both have invested 100,000 in opening the restaurant, and if we prepare a simple balance sheet, we can say that they have a restaurant building worth 100,000. In the current situation, we can say that they own 100% of restaurant because they invested whole capital by themselves. During this period, the restaurant performed well with cash sales totaling 60K. Cash and retaining earning accounts on their balance sheets are also increased. While Lala withdraws all money from the business for her personal use, Ahmed keeps this money in the business to grow the company. And by giving this money to Lala, he becomes the owner of 60% of his business. The first trick question: where does the money given by Ahmed appears on the balance sheet of another company? This money converted into a portion of the other company's equity. And since it was given to Lala herself and not to company, it does not appear on the company's balance. In the balance of the Ahmad's restaurant, the amount paid is treated as an investment. Acquisition of the 60% of the company means taking over the management and control of other company. How do we understand this? Let's imagine that the restaurant, which was founded by Lala, need a cook. They stuck between two options, Vasif and Asif. Lala wants Vasif to be hired, but Ahmad prefers Asif. However, since 60% of the shares in the company are owned by Lala, the candidate supported by Ahmad will be hired, not the candidate supported by Lala. Let's look at another example. Two menus are offered. One is deemed successful by Lala and the other by Ahmad. Again, since Ahmad has the majority of the shares and votes, the restaurant will be present a menu supported by Ahmad. This means that the assets in the company are managed by Ahmad. For this reason, when we create a single report, we collect all the assets. The investment is cancelled in the consolidated statement. So the company cannot invest in itself, and this amount is net off with the capital account in the other company. However, because Ahmad did not fully buy the other company, all his capital is not net off. In simple terms, if Ahmad manages the restaurant and makes a profit as a result, can he withdraw all money by himself? No, because Lala still owns 40% of the restaurant and 40% of the profit belongs to her. For this reason, the remaining part will appear in the balance sheet as a share that Ahmad cannot control. In other words, non-controlling interest. Now, let's look at the example taken from the revision kit. Pico has bought all the shares of the ESCO since its establishment. The statement of financial position as 31st of December is shown on the left. Creates a consolidated statement of financial position. We continue with a simple logic, cancelling out items which appear as an asset in one company and a liability in others. Then adding together all the uncancelled assets and liabilities on line-by-line basis, except for figures where one is an asset and the other a liability. We collect the rest. We summarize building and equipment. Investment are offset against with other companies' capital. Inventories are summarized. Other receivables are summarized, except receivable from ESCO. Cash is added together also. We have finished with the asset side. We turn to the capital and liabilities. As a consideration for the investment, the capital of the acquired company is cancelled. We only consider the capital of the parent company. Returned earnings are accumulated. But a small note, only post-acquisition part of the subsidiary's retaining earning must be summarized. In this example, the reason why we summarize it all is that the company was acquired from the day it was created. Bank overdraft are summarized. Accounts payable does not include the amount of receivable from the parent's company, and other payables are summarized. Finally, our consolidated statement is ready. If you liked the video, don't forget to subscribe channel and to click like button.